Welcome to Sustainability Talks here on businesstech.co.za, a series brought to you by RMB, where we're lifting the hood under the world of sustainable finance. And often when we think of sustainable finance, we think of green bonds, we think of social impact bonds, but we're going a little deeper to really understand how the taxonomy is evolving, how public-private partnerships are evolving in South Africa, and certainly to find out what's happening ever since the US has paddled back from its Paris commitments as well. And it's a great pleasure to have in studio today, firstly, Vukile Davidson, of National Treasury, Chief Director of Financial Sector Policy, who's responsible, certainly from the public policy and public sector side, for helping develop our green taxonomy. So Vukile, great to have you on. And we've also got from RMB, Nigel Beck, who is Head of Sustainable Finance and ESG, and someone who's really been at the coalface, no pun intended, of this evolving world for several decades now, Nigel, not giving away your age too much there, but maybe you could just kick us off, because often when we think of sustainable finance, we think of, as I said, green bonds, impact bonds, that kind of thing, which are often, I think you've said it as well, are outputs when it comes to innovation. And really, the innovation happens sometimes elsewhere and not visible to those who are not very close to the sustainable finance ecosystem. So where are you seeing the greatest innovation in sustainable finance at the moment?
So I think, as you say, the world understands green bonds. They've been around for a long time. There's the International Capital Markets Association. There's the Green Bond Principles. In the old days, it was focused very much on green and evolve, then towards social. So essentially started looking at what people termed sustainable bonds, which had an element of green and an element of social. But what we started to see is, I think, a move towards more structured products, this is structured sustainable finance products. So I think you mentioned earlier, for example, kind of social impact bonds, certain nature kind of bonds which have some type of kind of specific outcome, a deliverable that needs to be achieved that will impact the coupon, sustainably linked loans and bonds. Transition finance, I think, is a big growth area that we're starting to see globally. I think the world moves towards, how do you decarbonize the fossil fuel intensive sectors, petrochemicals, cement? How do you work with a company that's not green today and is unlikely to be green tomorrow, but how do you work them with financial structures that help them on their journey over the next 30 years as everybody tries to achieve net zero by 2050?
And I think it's important to understand that these things are not going to be achievable overnight. And it is a journey to the point of transition finance. It's how do you move a Sasol, for example, from where it is today to where it wants to be 2030, 2040, 2050. And the role, Vukile, then of public policy. I mean, often, Treasury or someone who develops public policy, you're seen as the regulator, the kind of referee or the gatekeeper. And often it's about creating this enabling environment to allow these kinds of innovations to thrive, to crowd in both public and private capital to provide these kinds of solutions. What do you see primarily as Treasury's role here in supporting the ecosystem to drive this kind of innovation? Because certainly in South Africa, we're a small open economy. I mean, we can't be setting the global rules here.
I think that's an excellent question, and there is a lot of different things we got to try to balance as policymakers. I think the first important thing for us to always keep in mind, that we try to always keep in mind, is that this is not about just the financial sector. This is about moving the real economy onto a path that is less carbon intensive, in line with our Paris commitments. And that requires, I think, an understanding, like Nigel just flagged, of a journey and not necessarily just a once-off step change. So we've got to think about how we shift the entire economy over a sustained period of time. We've got to understand how we manage those hard-to-abate sectors and get them to transition and provide sufficient incentives and, in some points, disincentives over a sustained period of time for to reach an ultimate goal of that sort of net zero by 2050. And this is also anchored by our own sort of domestic commitments. And you would have seen that in the overall architecture of how we've approached sustainable finance, from the sort of foundational, most important policy intervention, which is the carbon tax, but how that is very closely aligned through various mechanisms, be it the taxonomy or carbon offsets, with what is happening in other jurisdictions and international space, to strike that important balance of getting the domestic economy on the right path, but not placing domestic firms at a massive disadvantage vis-a-vis other jurisdictions.
It's a tough balancing act because, as you say, we operate in a global economy. Automatically, if your inputs are very carbon intensive, there is now a cost that is borne by local producers, and that will impact their global competitiveness. So it's a tricky one to get right. And how do we do this at a global scale? Do you think, Vikile, ever since we've seen the US particularly take a step back from its leadership position, that there is maybe a sense that we need to be very mindful of that pragmatic middle ground as the world tries to achieve its net zero commitments under Paris?
Yeah, I think that there's no doubt that the fragmentation of the international consensus around climate action and including sustainable finance has been complicated by, I think, slight divergence, or not slight, significant divergence, particularly in the US. We have seen, and we don't anticipate that this will be a smooth, singular sort of policy glide path, that depending on domestic political reactions, jurisdictions will go faster and slower at different points in time. But what we are convinced of is that the ultimate direction of travel is towards a much more low carbon, sustainable path. Given that long-term view, it is prudent for us to continue on our domestic policy path to ensure that the economy is sufficiently decarbonized, so it isn't significantly disadvantaged.
Very interesting. Nigel, what are you seeing amongst your clients?
Yeah, so I think, to just jump on the back of what Vakil is saying, is the direction of travel, I think, is still forward. What we're starting to see is that, although the US at kind of maybe a national, federal level is, stepped out of the conversation, we still see US at a subnational or corporate level still very much involved in the conversation. Right. So if you look at, for example, US sustainable investment, last year, I think it was around $6.6 trillion, and that was marginally up year on year. So it hasn't gone down, it's marginally up year on year, and it's still around just over, say, 10% of AUM, global AUM or US AUM. There's been a number of surveys of kind of US investors around, what is the perception of the negative sentiment at the moment with regards to sustainable investing. And only 5% believe that this negative sentiment will persist. The majority believe that this is just temporary and, the direction of travel will remain as it is. But I think what we have seen is that, for example, the Chinese have stepped into the role as very vocal, very involved with the sustainable finance, very much from a climate technology perspective. And the Chinese come at very much from a commercial end. They don't come at it from a principle perspective necessarily. And I think that's largely to do with, for example, 40% of renewable energy, 60% of electric vehicles, 75% of batteries all come out of China. So there's a strong drive towards sustainability and sustainable finance that's coming out of China. I think that's supported by Europe as well. I mean, recently, China and France came up reaffirming their kind of climate commitment. So interestingly enough, 10 years ago, China were actually at the table. Now, essentially, they're leading the discussion around sustainability and sustainable finance.
Those are very interesting numbers there. And it's also, I think, if you just look at it from a business strategic perspective, it's about deepening resilience, deepening your resilience to climate shocks, be they floods, be they, if you're looking at, some of the hurricane events there in Florida, for example, how difficult it might be to get home insurance. What does that mean to the property market? These are real impact from a changing climate. So where do you see the biggest innovation currently, Nigel, globally, when it comes to looking at how you can use sustainable finance to deepen economic resilience for business, and in which sectors are you seeing real opportunity?
So I think the narrative's slightly shifting at the moment. So if you look at what was coming out of COP30, was essentially coined as the adaptation COP. And I think previously, historically, we focused very much on mitigation. The drive has been trying to keep temperature rises below 2 degrees and ideally at 1.5 degrees. At the moment, I think we're on a trajectory to 2.3 to 2.5. So we're essentially going to overshoot. I think now the world is starting to move towards, okay, we're going to overshoot. We're starting to see the impacts of that. Climate change is very real. We've seen fires in LA. We've seen floods in Limpopo. We've got a massive snowstorm about to hit the US. How do you actually adapt to that, and how do you mitigate that specific risk? So I think what we're going to start seeing over the next while is a strong focus on adaptation finance, insurance products, banking products that focus on adaptation, sustainable agriculture, drought-resistant agri, et cetera, and how do you finance those specific sectors to be prepared for a change in weather patterns? So that's one element. Transition definitely is going to be another area of focus going forward, and I think carbon markets are going to start to develop as well. I think both carbon trading, carbon finance is starting to mature a little bit more. More and more countries are putting in, either a trading scheme or a carbon tax. And essentially we're getting to the point where you're actually able to trade, between certain countries using your tax legislation, essentially using Article 6.4.
Again, though, it comes back to having that interoperability at a global level to agree from an accounting perspective, certainly, what you're measuring, what your outputs are in order to develop a global trading scheme, especially when it comes to carbon markets. What do you see as the role for public-private partnerships in all of this, Vukile? Because again, often when we look at transition finance, for example, sometimes you need maybe a bit more of a DFI type first risk approach to crowd in some more private sector capital to make things work. But what do you see as the role of PPPs in this space?
How should countries think about sharing the burden between the private sector and what are sometimes viewed as uninsurable risks, and how policy can best react to that? The other thing, of course, was transition, which also is fundamentally linked. It has a fundamental private-public dimension. It is thinking around the enabling environment, but also encouraging individual firms to internalize in their own strategic planning how they are going to think about mitigation and adaptation, both in the face of severe weather-related events, but also what they can do from an investment planning perspective around mitigation. And then that's further sort of bolstered by carbon offsets, which you just mentioned, in carbon markets, but then also the design of the taxonomy, which is a classification system that really directs individual firms to identify what specific assets and projects are sufficiently carbon and climate friendly to reduce the cost of making those specific investments. So that's just in the broader context. Your specific question around PPPs, the work that we've done and everything that Ralph sort of mentioned has to be delivered by the private sector. So the private sector is indispensable, in our view, from the policy design. So these are not largely public sector initiated sort of projects. The whole policy framework is really geared around trying to understand what incentives we need to provide the private sector for them to make individual decisions that will be aligned to their own long-term sustainability.
And sometimes those, for example, in green steel, it's about thinking about how you create lead markets to develop what is ultimately, on the outside, looks to be a really good opportunity. We've got abundant iron ore, we've got lots of renewable energy. We're talking about inputs around green hydrogen in that part of the economy as well, close to a deep water port like Saldanha, and then exporting into a market like Europe, which would be very hungry for green steel. But it will require significant upfront capital investments from likes of AMS or whoever else. And so it is very much working hand in glove with the private sector. Nigel, what do you, from a banking perspective, what do you see as critical to making that kind of PPP model work and really bankable from where you use it?
So I think, the private and public sector need to have open communications. We need to align on what's priority, what we really want to focus on. I think, that's one of the key things. Quite often, especially in this space, there's a number of different initiatives, and it's difficult to focus on, well, actually, let's put all our effort into this. Let's create a policy environment that's actually going to enable that specific initiative. And is it right and fit for purpose for the country? And do we have the right? So, for example, as you say, is it green steel? Is that something that we should be focusing on? Or is it green hydrogen, or, is it electric vehicles, et cetera, et cetera? I think, that would very much help the conversation. I think creating the enabling environment specifically from an incentives perspective. So, some of these initiatives are obviously really expensive to get off the ground. You need an off-taker. You need to be able to kind of manage that cost on a comparable basis. So, for example, if you look at green hydrogen, that's comparably more expensive than traditional hydrogen or, traditional energy sources. Now you've got to try and invest in that. You've got to invest in that technology with the hope that you kind of get that parity. And at some point it will come down. If I remember when we did the first renewable energy projects in this country back in 2012 or whenever it was, those were priced quite high, and it was more expensive than coal. I mean, that's come all the way down and made it a lot more competitive. And I think that's exactly what we need to do. But the idea is you need to have that first step. There needs to be that enabling environment that creates that first step, which is exactly what we had with those kind of projects. We need something similar, a collaboration between the private and public sector to develop those type of projects.
Do we have anything like that at the moment, Vikile? Like a working group, for example, between Treasury and the private sector, as you develop the taxonomy, as we develop the ecosystem, to say, let's have an open door policy. Let's talk to business. Let's let business know also what the hard trade-offs are that we're making to ensure that we create this enabling environment.
So in the development or in the publication of our overall strategy around climate finance, we set up a specific forum to be able to understand what the private sector needs, to try and identify, as Nigel said, the sort of a prioritization and what the areas of clarity that would result in the most economic benefit, and help us structure and order the policy reform area around sustainable finance. So that we're doing that through the creation and the establishment and the functioning of the Sustainable Finance Initiative. It's private sector and academia and civil society all working together to understand the impact, prioritization, and identifying what other areas, policy, regulatory areas need to be changed, amended to try and get us to a place where we can catalyze the sustainable finance that we need to make these investments.
Because we are net importers of capital at the end of the day, and I mean, it's in the hundreds of billions of rands, and we probably need annually, Nigel, I stand at a correction, in order to help with transition, with to help with all of these aspects and goals.
Yeah, I mean, what came out of the G20 was this commitment to kind of mobilizing transition and essentially sustainable finance from essentially the global north to the global south. And the idea is, how can you create the right kind of policy incentives, et cetera, to scale that from essentially around 30 billion to 330 billion or whatever the targets. I mean, you'll know those numbers better than I am. So the idea is, how can you focus on kind of mobilizing capital in the right direction? And I think one of the useful initiatives that Vakili is talking about is the fact that there is cross collaboration across the private sector, the public sector, through the Sustainable Finance Initiative, along with DFI. So we can all work essentially together to make sure that we position South Africa optimally to access those kind of pools of capital. So, looking at kind of the SA Green Finance taxonomy, how do you use that? Is it fit for purpose? Does it need to be slightly adapted? Do we need to focus, evolve it a bit, to look at maybe elements around transition, elements around kind of social, elements around adaptation to make it interoperable with international taxonomy, so we can essentially be aligned in our definitions and direct the capital in the right way. If I think about the sustainable finance ecosystem over the last 5-7 years, it's evolved extremely quickly. It really has evolved extremely quickly. And there's always a need to constantly refine essentially what you're doing. And I think some of these conversations that we're having are going to be particularly useful. So if you look at, for example, this sustainable finance kind of global market, I think I think last year was about $1.6 trillion. It's plateaued a bit globally, but it's come off 11 years of growth of about of 45%. Within South Africa, the market's a lot smaller. It's about $85 million. So it's a significantly smaller market. We've only had 5 years of growth because we started a lot later, but we're growing at about 67%, and we've not plateaued at all. We still continue to grow. And that's just within South Africa, never mind the rest of Africa, where there's significant opportunity. Still, there's been very little of the market that's been tapped. So I think, within South Africa and Africa, there's significant opportunity for us to grow this market and essentially capitalize through these conversations between the public and private sector.
And on that, I was reading a Green Cape report just published last year, I think, analyzing our green taxonomy. And for example, looking at countries like Rwanda, directly comparable in Africa and elsewhere, Indonesia, that in their do no significant harm component of the 3 pillars of the green taxonomy were maybe slightly more flexible in allowing for projects that are maybe not fully aligned, but at least are aligned with the other 2 pillars of making a significant contribution and also mitigating the social impact. So allowing maybe a bit more flexibility there would enable greater funds to flow in. And so those kinds of tweaks, to your point, Nigel, I think will get us. But, it's a process. It's very much a journey, this, isn't it, Vukile? So where do you see us sort of 5-10 years down the road, and what do you see as the big opportunity here if we get this right as a country?
Yeah, I mean, so there's a really interesting trade-off. You want as much flexibility to reflect what's happening in your own jurisdiction, but to Nigel's point, you also really want a direct comparison to the major economies so they understand exactly what you're doing, because they require a certain amount of comfort when they invest in your jurisdiction, that what they're doing is aligned to their understanding of green objectives in their home jurisdiction, where they have particularly reported a lot of their own reporting and disclosure requirements around the investments that they're making in other parts of the world. So it's a balancing act. Want some flexibility, and that flexible component will rely on domestic resources, and then you want a much more easily directly comparable part, which is, I think you need that to be slightly larger, to provide external investors with the comfort, clarity, and understanding of the types of investment that they're going to make in your jurisdiction. Then I'm not going to pretend that we have that balance absolutely right. I think it's a process of engaging with the private sector and understanding how we calibrate that correctly.
So sorry to just jump in on the back of that. So, I mean, I think if you look at, international investors have specific pools of capital that are directed to certain initiatives. So, for example, there's green, certain criteria that fit the green. That's slightly different to transitions. So there's a different pool of investors trying to target transition. The criteria is different. Social is different as well. So what we really need to be doing is we need to be tailoring our taxonomies to be able to essentially access those specific pools of capital. Within the private sector, what we have started to do, and we do a lot, within RMB and obviously a lot with our clients, is develop sustainable funding frameworks for certain of our clients, which then set out what those specific criteria are, what eligible assets are, et cetera, and that enables us and certain of our clients to raise capital through those specific pools into the South African market. Now what we need to do is we actually need to scale that. We need to be doing more of that, to be bringing more of that capital in. But essentially those criteria do exist. It's now just finding the right way to standardize it and introduce that into a taxonomy that's kind of globally applicable or nationally applicable.
Yeah, and what does then 10 years down the line look like in terms of success for you, Nigel, given that there is a time to choose? Retirement of the conversation as well, and just it's part of the everyday financial toolkit, and it probably we're very on in that maturity curve. But where do you see us?
So I think what success looks like for us in 10 years is to the extent that within South Africa we've essentially leapfrogged a lot of the other international markets, because I think we're in a position within Africa that's quite unique where we can leapfrog. We can leapfrog a lot of the international markets by not having to go through the same essential process, because we're a developing economy. So, in the same way that fixed line telephones are no longer relevant, we've leapfrogged. I think within the green space is an ability for us to get our ducks in a row, to essentially lead the market, and be seen as credible partners internationally for the kind of flow of capital from, as I said, the global north to the global south. Bearing in mind that there's a lot of capital available for development within Africa that is green, social, sustainable, and there's an ability for us to capture. So I think, for me, the world's our oyster in 10 years' time if we play our cards right.
Yeah, well, and Vakili, for you, from Treasury's perspective?
Yeah, I mean, I think that's what Nigel says. I think is broadly right. You're going to see much more interaction on jurisdictions that are willing to move fast in this area. There will be much more direct mutual recognition from those countries that want to move quickly. The EU, I think, is a very good example. I think that they will continue on their path. For a country like South Africa that has very deep trade, deeply integrated from a trade perspective with the jurisdiction like the EU, there's going to be significant incentive for us to align there and to get those benefits. And there will obviously be a first mover advantage for those emerging economies that can manage to provide the policy clarity to allow for those flows to occur. And lastly, I think that Nigel's right. We have a really massive, almost generational opportunity to establish South African firms and the South African financial sector as the dominant provider of climate-related and sustainability-related finance on the continent, and to have South Africa really operate as an important hub and stepping stone for those critical investments that will happen across the continent, which will hopefully happen.
And those are so important because you're talking gross fixed capital formation. That's investing in new factories, plant equipment. This is not fickle financial flows. So this creates jobs. This really grows an economy sustainably. Nigel?
Yes. So I think, talking about that 10-year kind of horizon, and essentially it's just going to be mainstream. The conversation that you're having at the moment where we're talking about sustainable finance, it's probably going to be finance, but the finance will be sustainable, because I think by then it will be mainstream. Even if I look at the evolution of sustainable finance within the bank, for example, or even within our clients, essentially it starts off with a conversation in kind of renewable energy, and then it moves into kind of a real estate sector around kind of green buildings. And slowly but surely, it's a conversation that you're having with every different business unit within the bank, and there's green products and there's green services within that specific business unit. They're growing and becoming more mainstream, and the conversation is just, those are the products that are being offered to clients. So I think in 10 years' time, for me, success would be where sustainable finance is essentially broadly how we look at it, and it's just finance, kind of with this sustainable lens that's very much just mainstream.
Fantastic. And starting with conversations like these, thank you very much, Nigel Beck at RMB, Vakili Davidson at Treasury. Been great having you here on Sustainability Talks, episode 1 here on businesstech.co.za, where I hope we've got you thinking a little differently and a little bit more innovatively about this huge opportunity, generational opportunity, as Vakili Davidson of Treasury said, to reframe the way we think about sustainable finance. From me, Michael Avery, look forward to catching up with you next time on businesstech.co.za.